9 stocks to buy now that are equal to stealing money. I thought this was a very important video for us to do today. I'm about to go over 9 different stocks in this video that I feel are like stealing money for long-term investors out there. I thought it was an important video to do, and the reason I thought this was an important video to do is right now in the market, you have so many people talking about AI stocks, NVIDIA, AI stocks, NVIDIA, are we in a bubble? Those sorts of things, right? And I'm here to take you through a lot of non-AI related companies that are like stealing money if you're a long-term investor, that are at the most attractive valuations these have been at since a great financial crisis, and some of these even before then, okay? So there's a lot of deals out there. All I ask in return for this video here today is that you smash the thumbs up button and you make sure you're subscribed to the video. That's all I ask in return. I hope you can do that for me here today, folks, because I've spent quite a bit of time putting these 9 stocks together here in this video for you. And these are the type of stocks that aren't just important from the perspective of like, these are stocks to buy, like you can buy it once, but these are the type of companies that if they go down in any substantial way, in any market dips, you feel comfortable putting more money in these stocks and buying the dip on it rather than just feel like I could just buy it one time and that's it, okay? Now, very exciting day here today. I signed up 6 new 6-figure award members here today in the private stock group. We had 6 new members reach 6 figures or more in their portfolios, and we had somebody hit the exciting 7 club here today. So my wife just sent those out here today. Very, very exciting. And that comes on the back of the Patreon squad. Trevor sent out 14 Patreon squad members. My wife sends out the 6 and 7-figure ones. Trevor sends out the Patreon members. Absolutely incredible. So I want to say congratulations to all folks hitting new milestones in your portfolio, and it's very, very exciting. I mean, you know, that's a heck of a run there. If you're looking to join my group of super investors, check out the pinned comment down there. That'll be to apply to join my private stock group. Fill out an application to join us in there. If you want to join my Patreon, that will be the other pinned comment down there, okay? Alrighty, guys, stock number 1 of these 9 stocks that are like stealing money right now for a long-term investor is Starbucks. S-Bucks, good old Buckies, okay? This is a stock that's down about 12% in the past year, but what's fascinating about Starbucks, I went back in time and I said, what has this stock really done over the past several years? And you're going to be fascinated by what you see here, okay? I posted this in the private stock group last night. 4.5 years ago, Starbucks was higher than it is today. The stock has done nothing for over 4.5 years. Absolutely nothing, right? And that's pretty mind-blowing to think of that. And the reason it's so mind-blowing is I went back to 2009 through 2019 and kind of looked at that decade and wanted to see, you know, how many times does Starbucks actually have some trouble, right? Look at this. I could find only one down year in Starbucks' entire 2009 through 2019. One down year where the stock was down 6%. 8 of those years had over 10% gains, which is absolutely amazing. And some of those years had ridiculous gains, right? 143%, 41%, 45%, 48%, 48%, 38% in 2019. Starbucks was known as one of the most quality, one of the best stocks you could ever own out there in the stock market. And that has obviously gone away, right? When your stock does nothing or actually downtrends for 4.5 years, whew, you know, you're in a different type of time period, right? But what happened over the last 4.5 years, and honestly, what happened in 2009 through 2019, it also irrelevant in the end. What matters is what we're paying for the stock today and where the stock is going over the coming years, right? So when I look at Starbucks here, I see a company that, you know, we can call it is expected to grow somewhere between 7% and 10% over the coming years, each year on revenue. And I think that's pretty realistic numbers. I don't think that's a stretch at all, right? And it's a company that if you look at the forward P, you're trading somewhere, let's call it 20 to 23, right? And so when I think about Starbucks, I think about a recession-proof business model because people, you know, they're going to go get their dang Starbucks, okay? It's basically a recession-proof business model, and the company's got decent growth. Is it, you know, insane growth? No, but it's decent growth. I wouldn't be surprised if they grow their earnings per share a little faster than they grow their revenues. So overall, I look at Bucks and I say, this is actually pretty darn attractive. And then on top of that, you add on the dividend, right? Which the dividend absolutely matters. It matters in a substantial way, right? For a stock like Starbucks. They have had 13 consecutive years of dividend growth. On top of that, they've had 13 consecutive years of paying out a dividend. So basically, since they started their dividend, they've been able to pay out and up that dividend each and every year. So if you go to buy Starbucks today, and let's say you're able to get Starbucks shares with a dividend yield of 2.4%, let's say, for instance, right? And you're going to buy Starbucks not just for the dividend, you're buying it for the capital appreciation, hopefully, over the next 5-10 years of the stock, right? But if you get it at a 2.4% dividend yield today, let's say, for instance, right? Well, there's a high probability they're going to keep up in that dividend. And so on the shares you're buying today, next thing you know, it's going to be 3% yield, 5% yield, 7% yield, 9% yield, right? As the years tick on and the dividend gets bigger and bigger and bigger as the company gets more and more profitable and they throw off more of that money to shareholders overall. So I look at Starbucks and I actually think it's very, very attractive. And it's the first time Starbucks stock has really been attractive in a long time. I'll be honest with you guys, it's been a long time since Starbucks stock has actually been attractive, and I think right now it is a very attractive stock. Anything under $100, I think is really looking good for Starbucks. If the shares can go under 90, that's when we're really talking. Okay, stock number 2 of these 9 stocks that are steal deals in this market right now is wait. I'm sorry, folks. I'm not even on to stock number 2 yet. We got to finish out the bad on Starbucks. I forgot. I did prepare a little bad news in regards to Starbucks before we move on to the next stock. That's Dutch Bros, okay? The only bad thing I can think about for Starbucks, the only bad thing is Dutch Bros, okay? And Dutch Bros is a growing coffee chain. They're a major competitive threat to Starbucks overall, okay? Here's the deal. Dutch Bros has a little less than 1,000 locations right now. I think Dutch Bros is going to be able to grow into 3,000 to 5,000 locations long term, which means there's going to be a lot more competition, at least in the United States, from Dutch Bros. Now, international, Starbucks, has their own other competitors in different markets out there, but inside the United States. Now, what I have noticed, because Dutch Bros and Starbucks compete directly against each other, and a lot of times right across the street from each other, in Arizona, where I've always spent a good amount of time, and then where I live nowadays, Las Vegas. Okay, Dutch Bros is in Vegas, Starbucks is in Vegas. And I've been to many times where it's a Starbucks pretty much right across the street from a Dutch Bros, okay? What I can tell you is I can't really see a noticeable difference in Starbucks' business when after a Dutch Bros has been in there for a while, right? Maybe initially it steals some business, but over time, it seems like, if anything, Dutch Bros helps grow the pie overall for Starbucks. And so, it's a competitive threat, but I also think it's a pretty, here's the deal, okay? How many burger chains are there out there, right? You could go to any major city just about in the United States, and there's a Carl's Jr. or Hardee's there. There's a McDonald's there. There's a Burger King. If you're on the West Coast, there's also In-N-Out, which is amazing, right? All these different competitors, and there's a bunch more competitors that I didn't just name that are competitors as well. Yet look at McDonald's numbers. And so I'll leave it there when it comes to Starbucks versus Dutch Bros. Is at the end of the day, Starbucks is like a McDonald's. They're going to put up their numbers. It doesn't matter how many other competitors you put against them, and you put the Carl's Jr. and the In-N-Out and the Burger King, McDonald's still puts up their numbers. And so that's Starbucks at the end of the day. They're still going to continue to put up their numbers regardless of competitive threats. What you could do if this is kind of what I call a pair investment, right? So instead of let's say put $10,000 into just one stock and say, I just like Starbucks, you could do a pair investment, which is putting $5K in something like a Dutch Bros and then putting $5K in a Starbucks. And you're kind of getting the best worlds, right? A Dutch Bros is going to bring you high growth, right? We know Dutch Bros is going to be able to add, ridiculous amounts of locations just in the United States alone over the coming, 10, 15 years. And we know their revenues and their earnings per share should likely skyrocket over the next 10 years, right? But for Dutch Bros, you're paying a very high valuation. Look at Dutch Bros forward PE and you'll see, oh boy, this is a high valuation name, right? But a Starbucks is very different. You're not going to get the growth you're going to get with the Dutch Bros, right? But you're going to get a very cheap valuation. And you're going to get a business model that's been through, Starbucks has been around for many decades now. So they've been through recessions, they've been through inflation, they've been through it all, right? So overall, I think it could be a pretty attractive maybe pair investment there overall, okay? Alrighty, so that's Starbucks. That was number 1. Now let's get into stock number 2 for real now at this point in time, okay? Number 2 of these 9 stocks is Whirlpool. Whirlpool. Famous company, obviously, very successful company overall. They make ovens, they make washers, they make dryers, they make, dishwashers, they make all these, basically needs-based things, refrigerators, freezers, all this stuff, right? And they own several different brands inside that. They also own KitchenAid brand and some others. Now, It's been a brutal last 5 years for Whirlpool. The stock's down 24.4% in the past 5 years, right? So it means if you bought this stock 5 years ago, you've lost a quarter of your value. Now, you have earned dividends throughout that time, so hopefully, if you're negative, maybe it's very slightly negative, or maybe you got a slight gain because you've had the dividend over the years, but still, that's brutal. To be down 24%, but once again, what happened in the past does not really matter too much for the future, right? The fascinating thing is, for Whirlpool, what has transpired over the last couple of years in the real estate market, it is worse than the great financial crisis. And that's hard to fathom when you think about the housing market in the great financial crisis. But for a company like Whirlpool, they need people moving. They need people moving from, one house to another house to another house to another apartment. They need people moving, move. And in regards to this real estate market we've been in, it's a frozen real estate market for nearly 2 years now. And when I say a frozen real estate market, I mean people just aren't moving. They're just staying where they're at, right? And this is the worst thing for Whirlpool, because when people move, many times they're either forced to get new appliances or they choose to get new appliances because they're like, man, I've had this, raggedy dang refrigerator for 15 years now. It looks super outdated. I don't want to move that into my new house, so I'm going to get a new refrigerator for the new house, right? And so the worst thing for a Whirlpool is where people aren't moving. It's a frozen real estate market. And you look at this, right? By the way, it was kind of an interesting telltale sign, in 06, 07 that the stock wouldn't perform. And then it obviously crashed massively in 2008. But it only had one down year in the great financial crisis. That was in 2008, right? It was down 47%, and then the next year it bounced right back with 103% gain and then 12%, right? But look at this, 37% down 2022, 9% 2023, and about 8% so far this year. That's way worse than the great financial crisis for this company overall, right? Now, here's the deal. The company is expected to put up $13 to $14 of EPS really over this next couple of years, which is very impressive considering we're kind of in bad times for Whirlpool overall. And so the company's likely trading at somewhere between a 7 and 8 forward PE, which is very low considering, once again, we're in a bad market for Whirlpool, right? This shows you United States existing home sales. It's horrible. We know it's horrible, right? Anytime you drop below 4 million, you're in disaster territory. Even below 5 million is really bad as well. Considering the population we have in the United States is bigger than it's ever been, to see these sorts of low ball numbers is awful. But what I'll say is, I would say, if I live in Vegas, we put odds on everything. I would say there's about a 90% probability the real estate market bottoms in terms of amount of existing home sales at some point in 2024. And in 2025, we start, the numbers will be, let's just call it, a lot bigger than 2024 in terms of amount of people moving, okay? And so that's where I feel like, so basically we're in likely the bottom out year for United States existing home sales. That's going to be good for Whirlpool. And then also interest rates, I would say there's about a 90% probability the federal funds rate starts to go down within 6 months as well, which is also good for a company like Whirlpool, because we do know a lot of people buy these appliances on loans, right? And so anytime the interest rate's in a very elevated place, that's not good for a company like Whirlpool, right? This is the last 10 years. By far and away, we're at the highest interest rates we've seen at any point in the past, okay? Now, when it comes to Whirlpool overall, 6% plus dividend yield, they paid out a dividend 25 consecutive years. 25, I think about how long I've been in the market. I've been in the market like 15, 16 years, and it seems like forever. And they were paying out dividends, consecutively 10 years before he even got in the market. Now, they stopped growing their dividend recently, which I think is a prudent action considering how bad the real estate market is and considering the fact that the dividend's like a 6% yield right now. So I think that makes sense overall there, okay? So that's Whirlpool. That was stock number 2 of these 9 stocks. Stock number 3 of these 9 stocks that is a steal deal right now is my big dog, Meta. I'm now sitting on a $614,000 gain in the public account on Meta stock. This is my biggest big dog in the public account, and this stock is a steal deal. Even now. Listen, here's the deal, okay? Everybody gets caught up in the past year. Oh my gosh, it's up 166%. It must be super overvalued. That's what they all say, okay? But what if I told you that this stock is actually dirt cheap right now? Dirt cheap. Let's go into the numbers and let's prove something, okay? So, in Meta's last earnings, first off, they beat on revenue by nearly $1 billion, and they eclipsed their earnings per share expected by analysts in a substantial way as well, right? So they've actually been consistently just smacking numbers out of the ballpark when it comes to their earnings recently as well, right? The earnings per share was up something like 200% roughly year over year from what I remember, and their revenue was up roughly, 25% year over year, right? If you're going to tell me a company's grown earnings per share by that much and they got 25% revenue growth, I'm going to say, oh my gosh. Now let's assume that earnings per share growth massively decelerates to 30 to 40% earnings per share growth. And then let's say even the revenue decelerates to like 20%. So let's say I'm kind of expecting like a 20% type revenue number over the next few years and let's call it a 30% EPS growth. Well, I would say, okay, so let's say we got $5, right, of EPS right now, times out by 4 quarters. So you got $20 of EPS roughly next year. Kind of in the bag. Roughly $20 of EPS is in the bag for next year, right? I would say given Meta's growth rates right now, it deserves about a 40 PE on this stock. Given the fact that this is a 25% grower, they're triple-digit grower on the bottom line, even if those decelerate massively to 20% and 30% over the next few years, you're not going to pay an inline 18 type PE for the stock. You're going to pay a minimum of a double because the stock's growing way over double where the average stock in the market's trading at, right? So I would say a 40 PE is still kind of conservative here, and you got an $800 stock, and the stock's $460 right now. It's a steal deal. Look at this. It trades at 23 times. Here's the deal. Analysts, by the way, are right at that number, right around $20 per share of EPS expected in 2024. That's a 23 PE. 20 times the next year. At a 34% earnings per share growth in 2024 expected. And keep in mind, Meta's been smashing numbers, so that 34%, it might be low. Meta might do $21, $22, $23, $24 of EPS in 2024. We'll see. 17% revenue growth expected next year. It's hard to say Meta's overvalued here. If anything, Meta's undervalued or a steal deal at this point in time. So, yeah, you can get caught up into the stock's up this much, oh my gosh, this and that. But at the end of the day, a steal deal is a steal deal. And the bottom line is Meta's still a steal deal at this point in time. Okay, stock number 4 of these 9 stocks that is a steal deal out there is Google McDougal. Yes, Google McDougal. So, when it comes to Google McDougal, you got to keep this in mind, okay? Because I think a lot of people, when they think of Google, they just think of Google search, right? Listen, this company owns so many massive businesses, it's ridiculous. But there's 4 core massive businesses you need to think about when you think about Google. And then they own a whole bunch of other growing businesses that are exciting for the long term of this company. But the 4 businesses you've always got to keep in mind when it comes to Google is they're obviously their search product that everybody thinks of. The second is the platform you're likely watching this on right now, YouTube, unless you're watching this on X. If you're watching this on X, let me know in the comments section on X, okay? But almost all you guys are going to be watching this video on YouTube. Google Cloud, which has been a massive growing business for them for many years, and they also own Android, okay? And once again, they own a bunch of other businesses. They've got AI capabilities. They got a lot going for this company, right? But that's the core business for Google McDougal. So here's the deal with Google McDougal. It's too cheap. The bottom line is too cheap. It's trading about 22 times this year's expected numbers, 19 times next year's expected numbers. The company's expected to have double-digit revenue growth, double-digit earning per share growth. That's just too cheap of a stock. To be trading at this valuation with double-digit top line and bottom line growth expected over the next few years, and a company that's obviously proven they can do that over time, is too cheap, way too cheap. And so Google McDougal is a steal deal here, okay? Next one up here, stock number, what are we up to? 5 of these 9 stocks is Zoom. Never really been interested in Zoom until now. Even Zoom has actually gotten interesting, folks. Yes, you heard me right. Even Zoom has gotten interesting, okay? Here's the deal. The stock is down 12% in the past 5 years, which is crazy to think. That's insane to think, actually, okay? And the reason it's so insane to think is the stock price is lower today when they were doing less than $1 billion of revenue on a trailing 12-month basis. Think about that for a moment. Today, the company's doing around $4.5 billion on a trailing 12-month revenue. So the stock price is, it's just ridiculous to think about. Like one of the craziest stocks I've ever seen, that they could over 4x their revenue and their stock price would be lower in the future. Like I think if you went back in time 5 years ago and you said Zoom's going to 4x plus its revenue over the next 5 years, but you're going to lose money on the stock, I don't think anybody would have said, yeah, I could see that coming. No. Everybody would be like, what? That's crazy talk, right? But that's the story of Zoom. So when it comes to Zoom, here's the deal, okay? It trades very cheap, obviously, about a 13 times forward PE. But analysts have the company actually having a decline in their earnings per share next year. And I guess, I don't know if this is really going to be a company in decline. I see they got several business segments that should be growing segments. I think a lot of companies have already finished up their cost-cutting measures in 2023, which included all the cloud-related services they use and softwares, and including things like Zoom. And so I think 2024 could actually be a decent growth year for the company. And I just have trouble seeing, outside of a major recession, right? I have trouble seeing Zoom's earnings per share decline in 2025. So, well, technically, actually, that would be 2024. That'd be 2024 because their fiscal year ends in January. I wouldn't want to make that bet. So, the moral of the story is Zoom's actually attractive. And I can't believe it. I really can't believe it. And you look at its balance sheet, it's one of the sickest balance sheets you'll ever see. About $6.5 billion in cash and short-term investments, no debt that I could find in that balance sheet, and only $1.9 billion of total liabilities. I don't know if I've ever seen a balance sheet. That might be the greatest balance sheet in the history of mankind. I can't think of another company that has, we can call it, over 3x the amount of cash and short-term investments versus their total liabilities. It's ridiculous. Not even the great Apple could put up that. I don't even think Google, McDougal, and Meta, and these other companies that have top 5 balance sheets in the world, I don't even think they could put up that sort. No, they can't. I know off the top of my head, they can't. They can't. So Zoom's got arguably the best balance sheet in the entire stock market. Let that sink in for a moment, right? Absolutely incredible. So, anyways, Zoom's actually looks interesting, to me at least, for the first time in probably its history, which is intriguing. Next one up here, stock number 7 of 9 that is a steal deal now is, the number 6 of 9, not 7. 6 of 9 is Cheesecake Factory. Cake. I love some cake, okay? Stocks obviously had a tough last 5 years. They had to deal with super high inflation. They had to deal with, obviously, Rona and restaurant closures and everything like that. Permitting delays. The companies had everything thrown at them in the past 5 years, okay? But with that being said, they made it through, and there's much brighter days ahead when it comes to cake. I have built my position so far up to 1,309 shares in the public account, and I'm going to likely continue to build that position. It's also, I believe, the number 2 biggest position in my Patreon portfolio. Once again, if you want to join Patreon, see the moves I'm making every single week, the stocks I'm buying, selling, check out the pinned comment down there. But when it comes to Cheesecake Factory, really like this stock. Now, I spoke extensively about this stock on the video that came out 8 days ago, 6 stocks I'm buying now, February edition. I talked probably for 10, 20 minutes, went really in depth on Cheesecake Factory. That video is up to nearly 50,000 views now at this point in time. So if you want to hear me talk really in depth about cake, definitely check out that video. But just for the little short, 2-minute, kind of 1-minute talk about cake, the main core reasons I'm investing in cake is they have their cash flow machine, which is Cheesecake Factory restaurant, right? It's a cash flow machine. It's one of the most successful restaurant chains in the world, and the company trades incredibly cheap. Based upon 2024 estimates, it's trading about 11.5 times. But it's not just that they got this great cash flow machine that is Cheesecake Factory restaurant. It's the growth opportunities over the coming years in these other restaurant chains they own. So they own what's called Fox Restaurant Concepts, which is a whole company that was created by Sam Fox, who, in my opinions, I will look at Sam Fox as similar to like a Steve Jobs, but of the restaurant industry. I think Sam Fox is one of the greatest restaurateurs of our time. I really feel like that. It's amazing how many different brands he's been able to build over the last couple decades now at this point in time, right? And so his company got acquired by Cheesecake Factory, and he's got other projects he's working on in Arizona now at this point in time. But these all have insane potential. Some of these have maybe it's going to be 10, 20 locations long term. Some of these it's going to be hundreds of locations. Some of these it might be 1,000+ locations long term. Flower Child, insane upside there. They own Flyby. Culinary Dropout has ridiculous potential. That's a type of concept that maybe only 50 to 100 of those maybe around the United States over time, but talking crazy volumes they could bring in those culinary dropouts. They own the Henry. Blanco has a big opportunity. I could see 100, 200 of those locations over time. They own Doughbird. They also own Olive and Ivy, The Greenhouse, Zen Burger, The Arrogant Butcher, Wildflower, and Pushing Daisies. But the big dog that they own is North Italia. North Italia is going to give the biggest ROI, in my opinion, over this next 5 years specific. I think after that, you can talk about Culinary Dropout, you can talk about Flower Child, but North Italia is really where it's at, and I just look for massive expansion in terms of North Italia over the coming years, and I think, you know, by the end of this decade, there'll be North Italias in every major city inside the United States of America, and probably several locations. So that one is a slam dunk in my opinion. There's no question, no question at all. So Cheesecake Factory, dirt cheap, great growth profile over the coming years. They've been through major recessions. They've been through major inflation spikes. They've been through it all. And they've been through Rona, a once in a 100-year, health event. They've been through it all, and they made it through to the other side. And then they built into a stronger and stronger and stronger company. And so very excited about the long-term futures and prospects of cake. Number seven of these 9 stocks is PayPal. PayPal, it's stealing money. It's stealing money. Here's the deal, okay? I talked about PayPal extensively in the video that came out 8 days ago. I talked about it extensively in the January edition as well, right, which got 70,000 views. And, PayPal, I don't know what else I can say about it. It's stealing money, okay? Here's the deal. They just cut about 9% of their workforce, and so it was a move that needed to be made so the company could be more streamlined, they can move faster, and cut down on cost for this business model overall, right? And it's, to be honest, it's kind of in line with almost all big tech companies that have been doing that over the last year or two. When they reported their last earnings, they beat on EPS on a normalized basis, they beat on a GAAP basis as well, and they beat revenue estimates as well by $154 million. So they're coming off actually really impressive numbers. And now, under Alex Chriss, the company's reported 2 quarters so far, right, with him as CEO on the conference call. In both quarters, they beat. And this quarter was even bigger beats than the previous quarter, right, which means the old days of PayPal missing numbers might be long gone now at this point in time, right? Stock trades dirt cheap, 11, 10 times forward P on the stock, which is just silly. It's just silly. To put it into a 5-step process here, PayPal, dirt cheap forward P on the stock. The company should be able to grow revs between 5 and 10% over the coming years, right? Year after year, 5 to 10%. They could maybe do more than that if Alex Chriss makes these innovations they're working on actual big successes. Could we see a day when PayPal's growing 12, 15%? Sure. I don't want to bank on that, though. In my brain, the way I think about PayPal, 5 to 10% revenue grower year after year, and probably a 10 to 20% earnings per share grower year after year over the coming years, right? A very sticky business model, obviously, as we know, right? And a lot of people are starting to use PayPal and Venmo more often than they used to. Company has massive scale, which cannot be said for many fintech companies. I mean, how many fintech companies have hundreds of millions of people that use their apps every single month? There's very few, okay? PayPal's one of those, obviously, with their PayPal app and their Venmo, right? Plus, they own Braintree, which gets forgotten about, which is a back-end payment processor for a ton of companies out there. EPS is going to fly to the moon in the second half of 2024 and into 2025, regardless of the economy. The economy could be good, bad, great, okay, meh, it doesn't matter. Their earnings per share is flying in the back half of 2024 and into 2025. They're going to have a bunch of one-time costs that happen over this next, I would say, 6 months in relation to letting go of a lot of employees. It's going to mess up their earnings per share on a GAAP basis. But second half of the year, all of a sudden you're going to start to see PayPal report some ridiculous earnings per share growth, and everybody's going to be like, what did they just put up? What was that number? And then 2025 is going to be a great year as well. So PayPal stealing money. Next up here, stock number 8 of these 9 stocks that is stealing money is Alibaba. Mr. Dirty Cheap. Yes, Alibaba. So stock 71 bucks a share. Look at that. Brutal past 5 years. Down 60%. Ugh. I mean, the Chinese stock market has gotten so negative that Nvidia is now worth more than the entire Chinese stock market. Let that sink in for a moment. One stock, Nvidia, is worth more than the entire Chinese stock market, which shows you the level of negativity in not wanting to own the Chinese stock market. If that's not proof of just absolute massive capitulation, I don't know what is, okay? That's insane. Now, there's an interesting phenomenon that's hurting China. There's a lot of things hurting China in Chinese investments, but I think one of those is I've noticed a change over the past many years when it comes to the biggest, most powerful companies in the world. When I first got started in the stock market back in 08, 09, all these companies were talking about China, 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 China. How much they're going to grow in China. And I've just noticed a shift in sentiment where they're not as focused on China growth now. They're focused on where? India. They're focused on India. They're focused on building factories in India, stores in India, building their brands in India. And India seems like it's India has a lot more growth potential over the coming years than China does for these companies. And it's a market that you want to position yourself in now before it gets to the point of where the Chinese economy is now, right? And also, politically, it seems like India is a lot more open to business than China is, right? For instance, Meta has a substantial business in in India. Meta has basically no business in China, right? So Meta has basically no business in China. They have substantial business in India. So, where are they going to be focused on growth, right? India. And so, you could say it for a lot of these companies, to be honest. Google McDougal is basically non-existent in China. But I can tell you, YouTube's massive in India. Google's got a big game they're playing in India. What does Tim Cook talk about in every conference call? Does he talk excited about Chinese growth and this and that? No. What you hear Tim Cook keep talking about all of a sudden over the past few quarters, he's changed to India. India is, they're opening up new facilities to produce different products in India, right? They're building more stores. India is going to be a huge growth market. And so you go through all these different companies and it's all the talk is starting to go to India, 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 right? So that's a negative, obviously, for companies like Alibaba. And I also do think, I have a little conspiracy theory, and I do think the United States is trying to keep China at bay. I think the United States wants to continue to have by far and away the biggest GDP in the world. And so I think they're going to, I think the shift really started. It really started I noticed a shift in sentiment start right around the last year of Obama's presidency. And then it led into T-Man and then into B-Man. I do think the relationship's getting a little bit better, but I do believe there was a coordinated effort on the United States' part, regardless of political party, to kind of hold China down. That's my personal opinion. I don't know. Just take it for what it is, okay? And so to keep them at bay, but I do believe they really want to grow India. I believe the United States really wants to grow India a lot stronger. India and China they're not the worst of enemies, but they're certainly not the best of friends. And so I think there's a coordinated effort that the United States really wants to grow India's economy and power in the world over this next 10 to 15 years. And so, I think ultimately India will grow into a $10 trillion plus company. Now, where does that leave Alibaba? Well, Alibaba still has a massive market there in China, and Alibaba sells outside of China too. So keep that in mind. Alibaba can make a fortune in India, and they also sell in the United States as well, okay? Just through different services, not called Alibaba. It can be called something like AliExpress and different things like that, right? And so when I look at an Alibaba, it's trading at like an 8 times forward PE. The company's got decent growth, doesn't have the best growth in the world. And it's just too cheap. I would just put it like that, right? With sentiment that is just so horrible there. And, rich people still got money. You look at Wynn's latest numbers out of Macau that came out last week. They reported $524 million of operating income from Wynn Palace. There was an increase of $411 million year over year, right? It looks like China's just fine when it comes to the VIP, but the mass market's having a little trouble. So the moral of the story is China will continue to grow their economy over the coming years. They're going through a tough spot now. It won't be like that forever. Sentiment's horrible. It won't be like that forever. And Alibaba's in a pretty good position. So as China hopefully recovers and the Chinese stock market recovers, Alibaba should, in theory, be somebody that benefits from that, okay? Next up here, number 9 of these 9 stocks is Topgolf Callaway Brands. Topgolf Callaway Brands. This stock is up down 21% over the past 5 years. It's been a very tough last 5 years for Callaway, Topgolf. They own, if you've never been to a Topgolf, you should go someday. It's pretty awesome. It's pretty dang awesome. It's driving range meets bar meets lounge meets sports bar meets just fun place to hang out and have a good time with your friends or your family members, okay? And so they own that concept outright now. And they also own Callaway brand, which is huge in the golf space. If you've ever played golf in your life, you know Callaway brand. Like, it's impossible not to know. So they own those. They also own a few other brands as well, but those are two dominant brands they own overall. Now, it's a confusing kind of situation going on here because revenue is up about 5% for this company, just EBITDA up 90% in their latest quarter here, but net income actually fell 10%. And so they have a messy, confusing financial statement. I think that's turning a lot of people off from the stock right now, right? Look at this here. Net revenue is up 7.2%, adjusted EBITDA up 6.9%, but then net income down 41% for the full year. Non-GAAP numbers, right? So it's messy. It's messy. You look at the company outlook for 2024, revenue is expected to be up very nicely, $4.5+ billion coming off 4.2. Adjusted EBITDA 620 to 640 coming off 597. That's great. But then you look at their non-GAAP diluted earnings per share, 26 cents to 34 cents when they did 49 cents. So they got a messy financial statement. I think it's making a lot of people not want a piece of the stock because they're looking at it and they're saying, I don't know. Like, it's a hard one to gauge when you got top line growth and you got adjusted EBITDA massive growth, but then you have EPS or net incomes that aren't looking very attractive. Now, I found this here, right? If you look at their latest quarter, income from operations jumped substantially from a horrible number of only $2 million in the same quarter last year to this most recent quarter they just reported. Income from operations jumped to $23 million. So that's like good. But then look at this. You have this massive depreciation amortization number here, $45 million, right? Which it seems like it's hurting their numbers short term because they have these big, huge depreciation numbers coming in there, and they own these massive Topgolfs now, right? And so it almost is a little bit more like a hotel company now, or Wynn Resorts, than it was traditionally a Callaway company that's just selling golf clubs and golf balls, right? Because now they have these massive facilities that are going to depreciate over time, which kind of can hurt your numbers overall, right? By the way, they should change their ticker symbol. I don't know why they have it as Mod G. They should change it to Top G. If they can do that, Top G for Topgolf. Like, if I was them, like, change this ticker symbol to Top G. You wouldn't be surprised if the stock does better. Now, the company looks expensive, right? But I don't actually think it's that expensive. I don't think it's that expensive at all. I think the reason it looks so expensive is because of things like depreciation, amortization, and other factors that just, make a company maybe look a lot less profitable than it really is, right? I graded their income statement. It's a D income statement overall. And inside these categories, it's like I really want to dig in deep here on like other venue expense, right? $317 million, but what's all in that number, right? Look at this. Cost of services excluding depreciation and amortization, $45 million. What's in that, right? So I would love to see more in depth on some of these numbers here. R&D expense was up to $34 million from $21 million. That's strange that there's that big of a jump there. That's over 50% rise in R&D expense. Why so much R&D expense all the time? Right? It's all of a sudden, right? So it makes their numbers look ugly. I kind of view this company as like under $15, buy, hold your breath, limited sizing. It's a little bit of a risky play, okay? Definitely the riskiest play of all the stocks we just spoke about, but it might be the one with the most reward potential of that bunch, okay? Appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed. Thanks for smashing that thumbs up button. And if you're looking to join my group of super investors, pin comment down there. Apply to join us in the private stock group. And we'll see if we can get you in there later this week. Much love and have a great day.